So there are two. One is how I play earnings, and another one, position sizing. Two topics today: how I play earnings, and the second one is position sizing. So let's begin. And I will the question about the market later at the end of the. Okay. So there are various ways of playing earnings, and this is the earning season going on. So I receive questions: how do you trade earnings? So there are various ways of playing earnings. Like how I do, and then so you would have a clear idea how you can also play earning. So there are three playing earning. One way of playing earning is anticipating the earning run. So by buying calls or puts. So give you example. Let's say earnings of a stock is coming in 2 weeks, and you make the list. So you know which companies are coming on earnings from now till 2 weeks down the road. You know if it's before a market opens or after market opens. So you create a separate watch list. You know where the stock is from the daily chart, weekly chart. Now you understand how the company's fundamentals are. You have to understand the fundamentals also, and the past earnings history, how it performs during earning, how the options look like, etc. So you have done all. Now during market, you just watch those stocks for earning. So let's say you find one stock which is moving good from the support. So you have to understand the support and resistance also, and you see the potential that the stock can run up to earnings. Let's say the sentiment is positive. You know that a stock 5-6 up, and here is my support level. So you know the resistance. You can buy that stocks which is coming up, and I do that. Buy the long calls and don't wait for the earnings run, whether it's running that day when you bought the call or whether it starts running after 1 day, 2 days, 3 days. Be aware of the earning date and sell before the earnings come. So don't, it could run up more and more and more till the time the earning comes, but you can get caught also. It can stop running up. So decide where you would exit, because in the earning season, it's a 3-month long. There are so many stocks. Out of 8,000, you just make a list of suppose 200 good stocks which move on earning. That's what I do. So there's a short list of 200 stocks. So there's always something going on. There's always a stock which is running or running down on earnings. So make a list of those stocks, find one or two, get in, and before the stock hits the target or major or minor or intermediate, hitting the resistance or the move you see is dwindling, the stock is stagnant, you get out and you get into something else which is about to make a move or it's making the move. And the same situation is reversing the long put, reversing by a long put. So if the stock is running down based on the sentiments or some bad news is already there, the company is fundamentally weak, buy the puts on that stock. The stock has to have a strong resistance. So you know that even if the stocks doesn't move up, doesn't have a hard up. So for the puts, the stock doesn't move down. It would have a hard time moving up. And if for instance, suppose if you get caught in earning, you didn't sell before the earning, the chances are that the stock, even though the earning, the stock would have a downward. Those stocks which are fundamentally strong to buy calls, find those stocks which are fundamentally weak to buy puts 2 weeks before the earnings announcement. And I do that all the time, and it works. So that's one way of trading earnings, anticipating earning runs. The next is the aggressive earnings play. So the aggressive is you buy calls or puts just before the earnings announcement. So if the earnings will be announced after market hours or tomorrow and before market hours, then you can buy calls and puts, but it's a dangerous um, trade, aggressive trade. You can lose all. So you have to understand the past history, the sentiment of the stock. You have to understand how the stock did recently, whether it was moving up or moving down. There's a positive sentiment. Fundamentally, the strong. Where is the resistance? Where is the support? And where is the target? This is a aggressive type of play because you caught. So it's the way I do is when I see a big potential gain in the stock. So if I'm right, I would make a lot of from the percentage point of view, I'll gain a lot, like 200, 300%. So I would buy only out of the money calls or out of the money puts, and I know that I could lose all. So this is losing 100% or 80, 90%, but gaining 200, 300%. So when you see that type of a trade, then buy it. Otherwise, avoid it. And again, in this type of trade, you have to understand identifying the support and where is the resistance. So if you know, you have to evaluate if the stock reacts negatively and you have a call where it could go. So on negative earnings, where it would fall, and what would be your situation of the calls. So maybe you have to then average down with the next strike, in the money strike, or next month. So then you have to manage the trade. So it is one of those strategy where you have to then manage if your trade goes wrong. The third one, which is my favorite, is after earnings announcement. So let's say so you have a list of 200 stocks which move on earnings. So every day you're watching earnings, right? So you know which one is coming up next week, when, before market, after market. So let's say the stock announced earning before market. You watch during the pre-market hours. You have to watch the reaction of the stocks. What was the earning and what was the reaction? It's always the earning reaction on the stock which you are monitoring. The earning can be very good, but the stock is not reacting, is going down. Earning could be very bad, but the stock is going up. So nothing to do with the earning. It's just what the investors think the stock should do. So you have to identify what the stock is doing. So the way to do it is, let's say in the pre-market hour, the stock is gapping down, or not huge, slightly gapping down, and you can hear the stock had a great earning or this and that, but the stock is down during pre-market hours, like down 2%, 3%. So you make that list of the stock in a separate window, and then watch when as soon as the market open. When the market open, then you see the reaction of the stock. Is it continuing going down after gapping down, or is reversing to the upside? So the way I do it is when the reversal is happening. So the stock is slightly down 2-3% on the earnings during pre-market hours, and then it opens that way, and then it moves up. So and it starts moving up aggressively. So the reason is moving some traders or investors think that this is a great opportunity to buy. On the gap down, the stock hit some major support, and that's what they think the bottom is. So if you can identify the support, and if you can identify the reaction to the upside, you can watch that stock on your hourly chart, on your 15-minute chart, 5-minute chart. You know where on the daily chart the stock is. You just have to see one time. So you don't have to see again and again when the market opens. You see it on the daily chart where the stock is. Actually, you should see even before the market open where it will open. If you were watching the pre-market hours, so if the stock is trading at 64 during pre-market hours, you look on your daily chart and you know where 64 is. So, and then you look it again when the market opens, and that's it. So you don't have to look at the daily chart. Then you are looking at the hourly chart and 35-minute, and then you time your entry and get in. But you have to make sure that you are timing, or you're buying or going long or short according to the direction you're predicting the stock. And it happens every day. There is some stocks which are moving by reversing their early morning direction, whether up and down. And so these are the three ways of trading earning. There are other ways of straddle. I don't do that. You buy calls and put simultaneously, and you're expecting a big move. One side loses money, but the other side makes more than what you lost. So, for instance, you can buy calls and puts at the same time. The stock gaps are big time. You lost money on the put side, but you're making a lot of money on the call side. So, for this kind of scenario, you need to make sure the move is big. Big, you will not make money. Sometimes even the move is big and the option doesn't move, and you lose on both sides, calls and puts. So for me, the best way of playing earning is this: earnings reaction and anticipating the earnings run. So I trade these. Sometimes when I'm kind of very confident that earnings will be positive, then I'm going to buy calls, or earnings will be negative, then I'm going to buy puts. I can clearly identify the support or resistance and the target. What is whether the company is really doing good for last 2-3 and positive earnings, I'll buy calls, or negative earnings, I'll buy puts. So otherwise, I avoid this aggressive earnings play. All right. So I do have a service for earnings. It's 147 for 90 days. It's at a highly discounted rate. If you're interested, please send me email, and I will send you the special PayPal link for 147. All right. So the next presentation is on position sizing. Mastering the market. So position sizing is very critical concept, and everybody should be aware of position sizing. I see it every day. Traders making mistakes. They come in, they become my member, and then the first trade I send, suppose they have a $5,000 portfolio, they put in $4,000, make money. Let's say make money. They put $4,000, and the option has moved 11% in their favor, though they are happy, and they lock their gain and send me email congratulating me. Nashi, I made 11%. And then, so if I inquire, okay, tell me more. I have a $5,000 portfolio. I put in $4,000 in your trade. I made 11%. So my portfolio has gone up. Uh, so, so that's the wrong way of trading. The right way is to distribute your amount in various trades and don't risk more than what you can lose, which in the option market, you can lose 100%. 70, 80% you can lose. So what if that person who put $4,000 in the trade and that trade goes against? Then what happens? Even if the trade is just not moving against us severely, it's just normal move, pullback, but he would see $4,000 to $3,000. His portfolio will see from down to 3,000 because 25% variation in the position is normal. We see that every day. So what will happen? That $4,000 investment and $1,000 cash, that $4,000 will become $3,000, and now he's seeing 20% wipe out in this portfolio. So so he will panic and he will sell that position. Now he has only $4,000 left, and to make that $1,000 loss, while I'm still in the position, our other in the position, and then later, a few days later, I would say, okay, lock your gains. Let's go to another position, and then he would say, damn, I lost that $1,000. So when I send the another trade, then he will put another $2, $3, $4,000, and that will go. Trade don't go right away. That will go 20% down. Exit again, and then he will repeat this process 1, 2 more times, and then his $5,000 is gone. So that's not the way to trade. So I'll explain how you should be trading. So he who thinks he knows doesn't know. He who knows what he doesn't know knows. Lao Tzu. So 9 reasons for position sizing. So if you understand these 9 reasons, then you will have a calm and confidence posture in your trading. If you follow position sizing, it fear in your trading. It eliminates panic, like the example I gave you. $4,000 position, seeing $3,000, the total portfolio is down 20%. That's a panic set in, and the traders exit prematurely. Eliminate rate of errors. So in order to regain that loss of $1,000, the same trader will jump in with another trade which he was not supposed to, and with another greater amount, and will commit errors because now he is in a suicide mode. Whatever it takes, I want to make my portfolio back to 5,000. So he will commit errors. But if you have a proper position sizing, you will build the confidence, you will have a discipline. So you know how much to invest in the trade. Doesn't matter how good it looks like. I'm going to put this dollar amount, and it builds the faith in you in your trading. So when do position sizing, before you even enter the trade, you know how much you will make, you know where would be the stop loss. So you in the trade, and then you will let your trade work its way. You will let the trade do its own thing. So you will not exit or panic. You will stand firm by your conviction that my trade will work. And if it doesn't work, okay, it doesn't work. I will get out. I know how much I will lose. And the good thing is, the best part is surviving the few bad trades. So if you follow the position sizing, you will survive few bad trades and still will be alive to trade next day and will come ahead. But if you don't follow position sizing and you jump in 3,000 here, 5,000 there. In 3-4 trades, your portfolio is down so much, like $1,000. Then you just don't care. You would put that 1,000 into the last trade, and that 1,000 will become $100, and account is shut down and bankruptcy in trading. So by following position sizing, you will eliminate some of the problems and have some of the benefits. So what is position sizing? Now it's the part. The question is, what is position sizing? So position sizing answers one question: how many shares or options contract per trade? So when you have a portfolio of suppose $100,000, so how many shares you will buy in this trade? Will you buy $50,000, 40,000, 10,000, 1,000 shares? It's Amazon and you're buying 1,000 shares, and if it's a GoPro trading at $5 and you're buying 1,000 shares, I see that every time people buy 1,000 shares. Doesn't matter what price of the stock is, just 1,000 shares. So that's not right. Or 10 contracts, or I buy 50 contracts. All the time people say, I bought 10 contracts. Doesn't matter if the contract is $1 or $10. They just buy 10 contracts. So that's not right. So if you understand position sizing concept, you should know how many shares to buy or how many options contract per trade. And controlling your per trade size as function of risk. So in other words, identifying the risk, you control your trade size. So if you understand your risk, then you will understand how much to invest in that trade. Some trades, as we know, have a higher risk. Some trade have a lower risk. So if higher risk, you will put, or you can lose bigger than what you lose. Not you would put less dollar in that trade. But if you think your entry is perfect, and the loss would be less normal, then you would enter in the trade with a bigger size. But you have to follow your exit. So what is your risk? You have to understand that. So if you understand risk, if you understand your portfolio size, which you should know every day, what is your portfolio size? You know how much you are willing to, and you know where is your stop loss. So 3 things you need to know. You know your portfolio size, you know how much you are willing to lose per trade, what is your appetite, and stop loss. So 3 things. So out of 3 things, 2 should be constant. They are not changing. What is not changing is the portfolio size drastically every day. If it's changing, you should be aware of, like suppose if the portfolio is 50,000, then it's 52,000, then goes to 54,000, or then 51,000. So you keep track of your portfolio on a weekly basis, at least. This risk is constant, is either 2% or 4%. You identify it at the beginning. So that's you have already identified. So you know your portfolio size, you know the risk you're willing to take. Only the third part in this equation, in this position sizing, is your stop loss. So how much you are willing to lose, 50% or 100% or 75%, 25%. So once you know this, then you just know how much you are willing to put per trade. So for instance, so these are the 3 variables of position sizing: portfolio size, risk tolerance percentage, and stop loss percentage. So let me explain. Portfolio size is, we all know what portfolio size is. We start 50,000, suppose it's at 52,000 right now. At the end of the week, it goes to 54,000. So that's your portfolio size. Risk tolerance percentage. It is the risk per trade based on your portfolio. So So for example, if I am a conservative trader, I may be willing to risk only 2% of my total portfolio. So if I have $100,000 portfolio and I'm willing to risk only 2% of my portfolio on per trade, I would write it down. 2% is my risk tolerance. Another trader may have a higher risk appetite, so he has a higher percentage. So he would say, okay, I'm willing to risk 4% of my portfolio in each trade. So out of $100,000 portfolio, he is willing to lose $4,000 in each trade. So he writes it down 4%. So these two things are constant. Now the third part is the stop loss percentage. So this varies from trade to trade and you have to estimate it. Or you can just say, suppose this is not, you can say, okay, for instance, I'm willing to lose 50% in the option. So if my positions go against me 50%, I will get out. So even this stop loss percentage can be constant. So based on these three figures, what is the formula? So let me first explain risk tolerance. So risk tolerance is how much you are willing to lose as part of your total portfolio. So that's what I said, either 2% or 4%, right? So you have to write it down, 2%, 4%, 3% of your total portfolio. How much you are willing to lose as part of your total portfolio amount. The stop loss, how much you are willing to lose in a given trade if the trade goes against you. So these three are the components of the position sizing. Let me first explain the position sizing models, and I will explain one, and the other you can Google or read by purchasing some books. So there are many position sizing model. One is called percent risk model, and the other one is percent volatility model. I will explain the risk model. Risk model is based on the how much you are willing to lose, 2% or 4%. The volatility model is based on the each stock's volatility, how much it moves. So it's based on how much this daily basis. Now here is the formula. So you can write it down. It's very easy. It's not that difficult. You can create an Excel worksheet. I intend to create an Excel worksheet and distribute, but you can create it. It's not that difficult. You can write down this position sizing formula. The formula is this: portfolio size divided by the stop loss percentage, and then multiply it by risk tolerance percentage. So you take your portfolio size and divide by the stop loss percentage, and then you multiply by the risk tolerance percentage. So for instance, if the portfolio size is 100,000 and your stop loss is 50%, so you will divide by 0.5, and if your risk tolerance percentage is 4, then you will multiply by 4, and you will come up with the some dollar amount, position sizing. So this dollar amount is telling you this is how much you need to in the trade. So let me give you the example, how to calculate risk amount, how much you're willing to risk. So for instance, if your portfolio is $50,000 and you said, okay, I am willing to lose 2% of my portfolio in all the trades. So what is the risk amount? The portfolio size is 50,000, risk tolerance is 2%. So you are willing to lose $1,000 on this trade. So you have already identified, I'm willing to lose $1,000 per trade based on your portfolio. 50,000 is your portfolio size, 2% is your risk tolerance, $1,000 is the risk amount. So you can figure this out every day based on your portfolio size. So at the end of the day, You know your portfolio balance, and then you just calculate your risk amount, 2%, which is $1,000. Now, give you the example by taking a stock. So let's say the stock is Amazon. The outlook is bullish, right? And you say, okay, the stop loss percentage is 50%, which means that if you buy calls and if you are wrong, you know, based on your technical analysis, your option will be trading 50% less than what you are buying for. So 50% is your stop loss percentage. Let's assume the current price of the call is $20. So if the price is $20 and you buy one contract, the per contract is $2,000. So you are investing, the per contract price is $2,000, right? And your loss is 50%. So the question is how many contracts you are willing to buy in Amazon? Is it 10 or is it 1 or is it 2? That's the question. How many contracts I will buy? So when the stock is Amazon is moving during market hours and you open your order execution platform window, at that time you have to answer one question: how many contracts am I going to buy right now? Is it 1? Is it 2? Is it 3? How many? So if you have done your homework before, you know how many contracts you are willing to buy. The homework is, you know your portfolio size, $50,000. You know your risk tolerance is 2%. Okay, it's 2% is $1,000. Now, when you do the technical analysis, you know if you buy the calls, you can lose 50%. So how many contracts? Each contract is $2,000 right now. So based on this data, risk tolerance 2%, risk amount is $1,000, contract buy price is $2,000, your stop is 50%, so your stop price is $1,000, right? So 50% stop loss means when contract is trading at $1,000, you will be getting out. You should be buying one contract of Amazon, not 2, not 3, just one. And the reason is, here's the formula which I gave you earlier. The portfolio size is 50,000, your stop percentage is 50%, and your risk tolerance is 2%. If you do the calculation, the investment amount is $2,000. And if the investment amount is $2,000 and Amazon contract is trading at $2,000, you can only buy one contract. If Amazon contract was trading at $1,000, you would have bought two contracts. If it was trading at $2,200, you wouldn't buy any contract because it's beyond your risk. You cannot buy 0.8 contracts. So you understand this. $50,000 is your portfolio, 50 is the percentage, 2% is your risk. You can only invest $2,000. And then if it's wrong, you would lose $1,000. So only you can buy one contract. Now, some traders say, no, my risk is not 2%, my risk is 4%. I am willing to lose 4% of my portfolio in every trade. I'm willing to lose that. So if the risk tolerance is not 2%, it is 4%, then based on the $50,000 portfolio size, you're willing to risk $2,000 per trade. Assume it's the same percentage, 50%. Stop loss remains the same, 50%. So now how many contracts you can buy in Amazon? You just plug in the numbers in this formula. 50,000 is your portfolio, 50% is your stop loss. Now it is 4% risk tolerance. So $4,000 you should be investing in Amazon. So if you are willing to invest $4,000, how many contracts you can buy in Amazon? You can buy 2, but you have to know that you have increased your risk tolerance to 4%. So you're willing to lose 4% of your portfolio in this trade. So if you understand this, you are willing to buy 2 contracts of Amazon. So if the Amazon contracts were trading at 1,000, you could have bought 4. If it's trading only 2,000, you buy only 2. So knowing this will keep you calm and have a confidence in your trade. Now, what if loss percentage is tighter? Instead of 50%, the stop loss is 25%. So if the stop loss is 25%, you can buy more contracts because your stop is tighter. So let's give you the example. The risk tolerance remains the same, 2%. So we know the risk amount is $1,000 based on the portfolio size of $50,000. And the stop loss percentage, you say, no, I will get out if I loss of 25% in that trade. When 25% hit, I'm out. So if you plug in these numbers in this formula, portfolio size is 50,000, your stop loss is 25%, 0.25, and then you multiply it with the risk tolerance, 0.02. So based on the formula, it says you are willing to invest $4,000, and each Amazon contract is trading at $2,000. So you are willing to buy 2 contracts now. So it's the same thing, same contract, same stocks, same risk tolerance, same portfolio size. The only thing you varies is the stop loss percentage, 25%. So if you only want to lose 25% and you stick to your initial stop, you can buy 2 contracts of Amazon. So in other words, if you raise this percentage, you need to buy less. If you decrease the stop loss percentage, you can buy more. So some scenarios. Scenario 1, which I explained already, is risk tolerance 2%. The stop loss percentage remains same, which is 50%. So as your portfolio increase, your per trade amount will increase. So you understand? So now what I'm saying, these 2 are constant in, let's say, in each trade. You just say, okay, each trade I'm willing to lose 2%, and each trade when the stock goes against me 50%, I'll get out, or the option goes against me 50%, I'll get out. So these 2 things are constant. The only thing is fluctuating in price. So when your portfolio goes up, you can increase your amount per trade amount. If your portfolio is going down, you're decreasing the amount. So this is what the trader makes mistake. Even though their portfolio size is decreasing, they keep on investing either the same amount or higher amount as a percentage of the portfolio. They keep putting the same money. So that's not right. They keep buying 10 contracts. They keep buying 10 contracts. Doesn't matter if it's $2 contract or a $20 contract. So don't do that. Scenario 2. Let's say the scenario 2 is 4%. Risk tolerance is 4%. You increase your risk tolerance from 2 to 4. You said, okay, I'm willing to risk 4%. The stop loss percentage is 4%. Your per trade amount will increase because you're willing to risk more. You're willing to risk 4%. Okay. So when you know that you're willing to risk 4%, your per trade amount will increase. Scenario 3. Risk tolerance remains same. So you say, no, my risk tolerance is only 2%. But let's say this option you're buying out of the money call. And out of the money calls, if the stock doesn't move, the time decay kicks in and you can lose 100%. So when it is that scenario, then you are when you are willing to lose 100%, then will decrease. because you are willing to lose 100%. Scenario four is that you are willing to lose only 25%. Then your trade amount will increase. So the point is, this plays role, the stop loss percentage. If you keep your risk tolerance constant, the stop loss percentage plays role. Is it 25% or is it 50% or is it 100%? Based on this percentage, your per trade amount will go up and down, and based on the portfolio size on a weekly basis. So 7 lessons we learn via position sizing. The first lesson is that you start small. So let me give you that example of a $5,000 trader. When he came in, he bought $4,000. He put $4,000 in the first trade, made 11%, and very happy. What if that trade had gone? So that's not the right way to trade. So start small. Avoid risky trades based on your portfolio size. Some trades you have to just let go, like Amazon, the PCLN, Google, sometime Netflix also. If it's, there's $10 option, Nvidia, your portfolio size is $5,000, even $10,000. These stocks are not for your portfolio, so you need to avoid these trades. But what they do, I bet 95% they are only looking to buy options in these big movers like Nvidia, like Baidu, Google, Amazon, because that's what they hear all day on CNBC, these other stocks. But they don't realize that these stocks are not for their portfolio. These stocks are for bigger size portfolio. So manage losing streaks. So if you follow the position sizing properly, you will be able to manage your losing streaks, because as you lose, suppose consecutively 2, 3, 4 trades, you will be decreasing your per trade amount, and you would avoid the gambler's fallacy. The gambler's fallacy is that $5,000 portfolio, put $4,000, lost $1,000. Now the portfolio is $4,000. So put another $3,000, lost another $1,000. Now the portfolio is $3,000. The third trade, put all $3,000, and that $3,000 became $1,000 and $500. So only $1,500 left in 3 trades, 3 consecutive loser. So don't care. The fourth trade comes, put 1,500, and that is also a loser. Goes to $200. So $5,000 became $200 in just 4 trades. Instead of putting, suppose, $500 in the trade, making a $200 or $150 profit, then putting another 500, then another 500, then when the portfolio goes to 6,000, then then start putting $600. When the portfolio goes to 8,000, then start putting $700. But there's no patience. Put all 5,000 in one trade. So another mistake, position sizing, avoid time-based profit objectives. Some traders have a objective of profit based on time, that they have some deadline, they have to meet some bills, they have to purchase something, or they are unable to meet their weekly goal. Suppose they have a certain goal to meet with respect to the profit, and they are running short, so they want to meet the goal, and they put more money in that trade. So they, suppose it's Thursday and Friday is coming and they are short of goals, they put too much money in one trade to achieve that goal, and that is the trade which loses money. So cannot do that. A stock doesn't know your profit objective. What is your profit objective? What constraints you have? The stock doesn't know. A stock will do its own thing. So stick to your position sizing plan and grow your account steadily, slow, gradual, with confidence, with patience, and have a plan. So this is a quote by D.R. Barton, and what he's saying about the story of a blown up account. I have talked to many folks who have blown up their accounts. I don't think I have heard say that he took small loss after small loss until the account went down to zero. Without fail, the story of the blown up account involves inappropriately large position size or huge price moves, and sometimes a combination of the two. So what he's saying is either the trader puts too much money in one trade based on their position size, their portfolio size. They put too much money in one trade, or something went wrong and the stock just moved too much against their direction and they lost. So, and sometimes it's just a combination of the two. They put too much money in one trade and the stock goes against and they have no control, and that position is wiped out, and that only position in the portfolio, that was their entire portfolio. I have a 6-month Mastering the Markets coaching program. If you're interested, send me email. We can book a 40-minute strategy session and we will talk. You ask me question, I'll ask you question, and we see if my 6-month coaching program fits your objective. And if it fits, then you sign up. If it doesn't fit, we are still friends. So if you're interested in knowing about 6 months Mastering the Markets coaching program, send me email. It is starting soon. The next batch will start soon. My email is noshi@financialmarketwizard.com. And if you're interested in signing up for my earnings, play is only $147 for 90 days. And right now I have another offer for swing option service, which is $17. So if you're interested in taking a 2-week trial, you can take it for $17. And regarding the market, we have the news about the government shutdown. The market, it's not acting or will not act like market will go down and all that. Is not like that. The market is still behaving normal, and the point to watch the S&P is 2815. So 2800 is the major target. So watch for a break of 2815 in S&P. My Dow Jones target given is 26,500. This is the immediate target, and the long-term target for S&P is 3120. So S&P is going towards 3120. So the thing is this: the market tells you in advance what will happen to the economy or the election or the impeachment or no impeachment, whatever is coming in the news next year or so. The market is telling you already. So the market is saying S&P is going to 3100. So if you write it down and say that market is going to 3120, stay in your positions, especially long term, you'll be fine. So 26,500 is the immediate target for Dow Jones. S&P 2815 is the resistance. So watch that. And S&P long-term target 3120. Let me see if I have a question. Just a second. What happened to the... All right. So if you have questions, please send me email and I will be glad to answer. Let me see if I can see some questions. Okay. 3% in, what do you mean by 3% and 8%? The 3%, 3% means the risk tolerance. So when I say 2%, 4% is the risk tolerance. You're willing to lose 2% or 4% of your portfolio in a trade, the stop loss percentage is different. That varies from trade to trade. Some trade you will lose 2%, 25%. Some trade you will lose 50%. Some trade you will lose 100. I'm talking about options. So, and you can set a default in option. So you say, okay, I will lose 70%. I'm willing to lose 70% in each trade. So based on the 70% stop loss, you know your portfolio size, you know your risk tolerance, whether it's 2%, 3%, or 4%. You you calculate your dollar amount and you put it. There were no slides today, or with regards to the charts, there were no charts today. This is another mistakes people make, and they say, why I don't make money. The reason I show charts every day, right? Every week I show charts. I post charts on Facebook. This week I didn't prepare charts to show you, but I'm receiving chats. Why there's no technical analysis webinar? So point is, the traders are emphasize on on the charts, the technical analysis, where they also need to understand these concepts of position sizing, risk tolerance, stop loss percentage, how you will handle. It's like, have you watched cricket? Cricket is my favorite, so I give you example. Sometimes you are hitting fours or sixes. Sometimes it's a time to take singles. So sometimes you're taking singles. Sometimes you're hitting for fours or sixes, home run. So that's the way you have to trade. When you're driving, sometimes you drive at 70 miles, sometimes you're driving 30 miles an hour. So what is the condition? Also, you need to understand the market condition. What is the market condition? So I think formula is great. You can put that into effect. But if the market condition is not good, or if you're stuck in few positions, or there's a major event coming, then you will reduce your exposure per trade. You're going on vacation 2 weeks from now, you know that you will be going out, or you have some emergency coming up, you know it can come. You have to take action. You have to reduce your exposure, right? You are traveling in 2 days, you don't want to open new position because you cannot manage. So you try to close those positions, even if it's like in option, if it's 5-10% loss, you close it. If it's giving you 20% gain, originally your target was 40% gain, you close it. You go on cash. So all these maneuver you have to do in trading, not just looking at the chart and say, okay, chart, I need to see the chart. You have to understand all this. So next week I'll prepare charts. This week I did not prepare charts. I gave you the target of Dow Jones, 26,500. I don't see any effect of government shutdown. Next question. To stick with the options can be volatile, so the person swinging option planning and the price movement can correct. So Scott question is, some positions will go 100% loss. Overnight something can happen. Some you only lose like 10%. The reason you're losing 10% is this. Let me give you an example why you would lose only 10%. And I can take 10% loss anytime. I mean, I just take it. And the reason I take it is this. There are many reasons. So let me think of reasons. One reason I lost, suppose my position is stuck and it's not moving and I see 10% loss. And let's say there's another stock which moving. So what would I do? Sit on that 10% loss and the stock is not moving, or liquidate and get into another position which is looking better and it's moving now. Right now it's moving. There is news. It's moving. Netflix is moving. I need to buy Netflix. I need to liquidate this Baidu, which is not moving, or Facebook, and I have a loss of 10%. So that's one scenario. Another scenario is this. Let's say your target was 98 for the stock, and you bought the option at when it was 92, and your target was 98, and you bought the option when the stock was 92. 92, the stock went down to 89 and 88. Stays there. Is it staying there? So your target is 90. Then it starts to move. Suddenly it starts to move after 2 weeks. It starts to move. Now it's 91, 92, 95, 97, 98. So when the stock reaches 98, because of the time it took, you're still at loss of 10%. So the mistake the traders make, they want to get out at break even or their original profit objective. So for original profit objective of 40%, the stock now has to go to 105 to make you 40%. But stock did not go to 105. It went first to 89, 88, and then it took time to reverse and go up, cross 92, your entry price, then it goes 98. Even if it's hit 98, it's still, you see 10% loss in your option position, and you're not exiting. You are saying that I will exit at 40% profit objective. So based on profit for 40% profit objective, your target is now 105, and that 105 will never come. 99 may not come, and at 99 you will be break even. But suppose the stock target at 98, it hits and then it reverses and it goes back to 92. Now you are loss, 100% loss. Then the stock is never going to go back to 98 in near future. So you have to understand that the formula, there is a formula for taking a profit and or understanding the target. It is based on all the technical analysis. So there is no clear-cut formula that you can plug in and say, okay, this is my profit formula. So it's all based on technical analysis where you will be exiting. So you have to understand your target based on the chart. Let's see, is there any other question? Someone said there is no voice, so it has to do with only one person. Okay, all right then, thank you. So there's no more questions. I answered, and if you have any other question regarding coaching, please send email. Please don't ask me on Facebook. I get lost in Facebook, it's too much. Send me email and I will answer all your but I may not, I miss it. So if you miss it, please send me and respond. Thank you very much. See you next time, Pacific.